Hi, thank you for everyone for coming out tonight. My name is Luan Zhang. I am the founder of TeenInvestors.org, and today is going to be our first seminar or first virtual Zoom meeting. In today's topic, we're going to discuss an introduction to the stock market. So it's going to be a very general overview. It's going to be very beginner friendly, and it's just to sort of pique your interest and define what it is and what it means to you. So a lot of you have probably heard of investing before. But may not know exactly what it means. So your first question might naturally be, why should I invest? Why is it something that should be interesting to me? So I've taken a quote here, which is, I made my first investment at age 11. I was wasting my life up until then. And this quote was from Warren Buffett, CEO of Berkshire Hathaway. So for those of you who don't know who that is, Warren Buffett is one of the most, if not most successful investors of all time. He's the current chairman and CEO of Berkshire Hathaway, which is a multinational or international company that has holdings and investments in all types of companies across many industries. He amassed a net worth of over $125 billion, making him the fifth wealthiest man in the world. He wasn't born into a rich family, so he sort of became the epitome or the icon of what it means to be an investor. He's able to turn personal money or take a very small amount of money and generate huge returns on it over time. And these are done through his own individual and sort of tested and learned investing strategies. The most profitable trades require great patience and being able to recognize positions early and hold them for a long periods of time, so you can double, triple, or even infinitely grow your money. So, for example, Warren Buffett started at just 11 years old. But so whatever age you are, you can start investing, and that will only give you even more time for your investments to compound themselves. So this is statistics of U.S. millionaire households, households that have a net income of over $1 million. So as of January 2022, there was over 22 million millionaire households in the U.S. alone, which is about 8.8% of the U.S. population, which is a staggering increase from the year 2000, which was just 3.8%. So one of the biggest factors in increasing this entire general amount of wealth is the stock market. So today, roughly 71% of all millionaire households have their assets invested in some sort of equities, which equities we will discuss later, but which is essentially just another word for stocks or similar stock shares in the market. There can be many different types of investing. So in recent years, maybe you might have heard of GameStop. There's a lot of sort of pump and dump or meme stocks where you can increase your money exponentially at an extreme rate, and you can double wealth instantly. And that certainly created a lot of millionaires in the past couple of years. Or you could go through long-term and more traditional sort of investing. So you look at dividends, you can look at growth, you can look at earnings, and you can sort of follow a company as it grows and increase your own value. So as a table of contents, today we're going to discuss what is a stock and how does it relate to the general economy, what is the stock market, and how can I, as an individual, become involved in stocks? So what is a stock? The definition, the purpose, and its implementations. So there are many types of asset classes that people can invest in. There are cash, which is obviously your Benjamin Franklin's, your $1 bills, your coins and such. So cash is sort of the very basic form of asset. You can use it. Everything essentially liquidates down to cash, and cash can be used to invest in other stuff. You obviously purchase stuff with it. So it is your most basic fundamental version of buying power and ownership. Next, there are equities. So equities are going to be stuff that we're going to focus on. It's going to be stock markets. It's going to be stocks, ETFs, index funds. We'll go through all that stuff. And then there's fixed income. So your bonds, your deposits, your banking sort of stuff, when you lend money to someone, your interest on that, your real estate properties, so private property, stuff that you might own, maybe you own an apartment that you rent out, and commodities, which are basically very common resources or natural resources, so like gold, silver, copper, and ownership in these will also increase over time when the value of said good goes up. But for today's class, we're just going to focus on equities. So stock versus a share. A stock is a slice of ownership in one or more companies, and a share is a slice of ownership in one particular company. So although these terms are often used interchangeably, they have slightly varying definitions. So if you want to think about it this way, each company has its own stock, which is a collection of shares. You can buy one share of a company stock, but you can't really buy necessarily stock. A stock is like all the shares of a company. So you're technically buying shares when people say they buy stocks of a company, but for most purposes, it's gonna end up being the same thing. So public companies. So public companies can decide to make themselves publicly tradable. So what that means is that any person or any other company that wants to trade their stock, trade in the stock. So let's say buy their stock, invest in the stock, sell their stock. Anyone can do that as long as the company is publicly tradable. You can purchase shares of a company. Shares will give you a very small ownership of the company. So when you buy a share, you have now invested your money into that company. And in return, you own a very, very, very small fraction of that company. So essentially, you are making yourself a very, very small owner of that company. So the number of shares available in the market depends on many factors, including the company's worth and the price of each individual share. So for example, Apple, like your phone manufacturer, Apple currently has 5,250,000,000 shares outstanding in the public market, meaning that if you purchased one of their shares, you would own 0.000000019% of their company. So it's a small fraction, but because you invest in that, if the company's valuation goes up, you are also going to make a profit because you are a co-owner. So prices for one share can range from a couple cents to a couple $1,000 or even higher. It depends on the company. Some companies will make their shares just a couple cents. Some of them will make their shares tens of thousands of dollars. So the price of the share is not necessarily as important as how many of those shares you buy or what percentage of your income it comprises. So the share price can change on a very large variety of factors that we will get into later. But just the basic premise is that when you buy a share, your entire goal is to buy at a low price instead of a high price. So because you are buying a share, you are an owner of that company. When that share goes up in value, from the price that you bought it at, you can sell it, and then therefore you redeem your profit, just like any other goods. Let's say you're buying, let's say you wanted to resell some items. You bought them at a wholesale club like BJ's, Costco. You want to sell them at a higher price to make your profit. So it's essentially the same thing, but except these are more intangible goods. So the mechanism of trading. So when you buy or sell stocks, we call that stock trading. So there are two basic transactions when it comes to trading stocks. You either buy shares, which is also known as long, or you sell shares, which can also be known as a short. So your goal is that if the price per share that you invest in starts to rise, you might want to sell some of your shares, and that's what we discussed before. You earn a profit this way. So this is how the majority of money is made in stock trading, and is essentially the foundation for all basic economic transactions. You want to buy low, you want to sell high, you want to maximize your individual profit. There's also the idea of shorting. So shorting means that you could sell off any current shares that you own, or you could short or sell before you even own any stocks, which might be confusing because how can you sell something if you don't own it? But it's essentially the opposite of buying. So if you don't own any shares of a company, you can short that particular stock, which means that you sell it. Now, since you don't own any of these stocks yet, you're making a promise you will eventually pay back the stocks for whatever price that you shorted it at. So when you short a stock, you are betting that the stock will go down. So because if the stock goes down, the share that you bought it at, the valuation you got, if it goes down in value, you can pay back a lower price than what you bought it for. So instead, you're making a profit in that sense. However, since you are betting the stock will go down, economic trends always want to make companies go higher. So it is usually riskier to short and less beginner friendly because it's much harder to predict than if you say buy and hope that the valuation of a stock goes up. So what is a stock market? So definition, properties, and we're going to talk about indices or indexes. So a stock market is a sort of an abstract concept, but it is essentially refers to a cluster of all buyers and sellers in stocks. So there's also the idea of a stock exchange, which is the infrastructure that enables companies to list their shares and offer them for sale to the public and facilitate trading. So a stock market is more it's a term that encompasses all the trading that happens inside a stock market. So a stock exchange is where shares of the companies are actually traded. So, for example, some of the largest stock exchanges in the entire world are the New York Stock Exchange, which is in the image on the right, and the Nasdaq Stock Exchange. So, although you don't have to go be in physical locations for trading, many decades ago, you did have to be. People went to these physical stock exchanges to trade their values, and still they are very popular today among corporations. They will send their investors or representatives to these New York Stock Exchanges, to the Nasdaq Stock Exchange, and they will make stock exchanges. So maybe in the movies you see with crowded rooms, and there's a green numbers and red numbers flashing across the screen. And basically that is sort of a representation of what goes on in a stock exchange. And both the New York Stock Exchange, or the NYSE, and the Nasdaq are located here in New York. So indices. A stock index is essentially a collection of stocks. So the index will represent how these stocks are moving as a whole. So for example, let's say I wanted to create a stock index. So let's say in this index, I want to put some shares of Google, some shares of Facebook, Apple, Amazon, sort of like the big companies. So because the index has all these stocks contained with them, it'll sort of map out the general trend of all of these stocks combined. So indexes can also be weighted proportionally. So that will affect how well it represents each thing. So for example, if it's weighted equally, so if I have, let's say I have 5 companies in my share. You have your Apple, your Google, Amazon, Facebook, and let's say ExxonMobil. So if you have these 5 companies in share, if you weight them all 20% equally, out of all the money invested into the index, then the index will track sort of the average trend of how all of them. But if you have an index weighted proportionally, you can make it so that, let's say, 70% of your stock of the index is made out of Amazon shares, 10% Google, 10% Facebook, 10% Apple, respectively. So because in this case Amazon is weighted so much higher in the index will follow the general trend. So of Amazon's stock. So let's say Amazon's stock went down that day. Even if Facebook, Apple, and Google went up, because they make up such a small fraction comparatively, the entire index will likely go down, because it will follow the general trend of Apple. So stock indices can help provide huge insight into the health status and health and status of the general economy. So what I was talking about was sort of like a personal index, but there are also like extremely large indices that you might have heard of that sort of are used as tools to map the US market as a whole. So we'll get into some of those right now. So your Standard & Poor's 500, which you might know as the S&P 500, is a float-weighted index, meaning that the market caps of the companies of the index are adjusted by the number of shares available for public trading. So if you have seen S&P 500 in the news or on a business journal or anything like that, that's not to be unexpected, because it is one of the most important and well-known indices in the entire world. The S&P 500 is an index consisting of the top 500 largest companies in the US stock market by number of shares in the market. So in this index, you'll see a lot of your big corporations like Amazon, Google, Apple, Activision Blizzard, which is a gaming company. All of these are featured within the Standard & Poor's 500. So the performance of the S&P 500 essentially reflects the performance of the entire US economy, which is why it's most closely followed. Like your top 500 largest companies, they are going to be running the economy essentially. Their profits are going to be driving the US economic growth. So if your S&P 500 is going down, it is usually a reasonable conclusion to draw that the economy is suffering right now. Another extremely popular US one is the Dow Jones Industrial Average, which is a stock index consisting of the 30 biggest American companies that are traded on the US stock market. So the Dow Jones is also referred to as the Dow, or maybe its longer name is the Dow Jones Industrial Average. So similar to the S&P 500, it's going to include your big names, McDonald's, Apple, Walmart, but you might notice when you're looking at the list of stocks in the Dow Jones that some of the largest companies are not listed on the Dow Jones. So like Google and Amazon are not listed on the Dow. And the reason for that is because the Dow Jones is a price-weighted index, meaning that each stock in the index takes up a fraction of the index that is proportional to its price per share. So stocks with a higher price per share will take up a larger percent of the index. So this excludes companies like Google and Amazon because their share prices are way too high. Google's share trades at over $2,500. Amazon trades over $3,000, and it's far too large to tip the scale of the Dow index. So it's going to be kept to large companies, but companies that do not have extremely high price per share values. So despite even missing some of these larger companies, the Dow and S&P 500 are both great indicators of the general trends of the American economy and the stock market as a whole. So if the S&P 500 and the Dow Jones are going up by a significant amount, it is likely that the majority of U.S. stocks, even across various different sectors, they will also be trending upwards. We also have the NASDAQ Composite Index, which is a market cap weighted index. So this index contains all the stocks that are listed in the NASDAQ Stock Exchange. So we can clear some things up here. So this NASDAQ Stock Exchange is an area where stocks can be traded. The NASDAQ Composite, or you can talk about it as just the NASDAQ, is the index that contains nearly all the stocks that are tradable on the NASDAQ Stock Exchange. So essentially, NASDAQ Composite is sort of the representative and trend of the NASDAQ stock exchange. Sorry. The NASDAQ is also a market cap weighted index, which means that the fraction of the index that each stock composes is based on its total market cap. So market cap is equal to the share price, so each individual share multiplied by the total number of shares outstanding. So if you have, let's say you're a company, you just started, you release 500 shares out, and the share price is currently running at $10, then your market cap will be 5,000. So the larger the market cap of a company, the more weight it has in the NASDAQ Composite. And there is also another NASDAQ index, also known as NASDAQ 100, which is different from the NASDAQ Composite. The NASDAQ Composite tracks the NASDAQ Stock Exchange as a whole. The NASDAQ 100 contains the top 100 non-financial companies in the NASDAQ Stock Exchange. So as a recap, the big three indices that are used to keep track of the U.S. Stock Exchange and the U.S. economy are your NASDAQ Composite, your Dow Jones, and your S&P 500. These are the big three that will be most often discussed about. So we've been focusing a lot on the U.S. stock market, but stocks are obviously an international concept. So some international larger stock exchange are the Financial Times Stock Exchange 100, or the FTSE, which is the international index for the London Stock Exchange. So the FTSE tracks the performance of the top 100 largest companies listed on the London Stock Exchange. Each company makes up 1% of the total index, meaning that all companies take up an equal part of the entire index. So some of the companies listed on this index may seem familiar, even though they're based in London. So Rolls-Royce and Royal Dutch Shell, which is an oil company, both of these are traded on the London Stock Exchange. So then there's this idea of ETFs versus indices. So an ETF is an exchange traded fund, which is a type of pooled investment. So these can be used to track multiple securities, assets, or indices. So they're very similar, but an ETF is essentially a pooled investment that can be used to group a bunch of different stocks together so that a variety of stocks can be traded in one group. Essentially, an ETF and an index are the same thing, except an index cannot be traded. An index is sort of like a representative of how a group of stocks is moving or a group of securities is moving, but you cannot invest in an index. However, you can invest in an ETF. So an ETF can be created to sort of map an index. So or an ETF can be created to allow you to invest in an index. So for example, if you wanted to invest if the economy is going to go up, if you were looking to a long-term investment, you might want to look into investing in the S&P 500, just track general market growth. But you cannot buy direct shares of the S&P 500. However, you can buy an ETF created that is exactly scaled and proportional to the S&P 500. So if we look at some examples here, so the ETF of the S&P 500 is the SPY. So these 3 or 4 letter things here, the SPX, SPY, DGI, DIA in parentheses, these are stock tickers. So if you search up, SPX, SPY, you will get all the information for the data. It is essentially like the abbreviated version that represents that stock. So if you wanted to invest in the S&P 500, you would have to invest in the SPY, which is the ETF tracking the S&P 500. Same thing with the Dow Jones Industrial Index. If you wanted to invest in the Dow Jones Industrial Index, you have to invest in the ETF tracking the Dow Jones Industrial Index. So we can look at an example here. So if we look at the S&P 500, this is stock charts. You can see that it's been going up and down. But if we go to ETF tracking the S&P 500, they're gonna have very similar trends, because the S&P 500 essentially tracks the SPY tracks the S&P 500. So we're gonna again, this is your index, this is your ETF, this is your index. It's almost an indiscernible difference between the two, but you can invest in the SPY and you cannot invest in the SPX, as you can see. There's also ARK ETFs. So these don't have to be huge indexes. Individual companies can create their own ETFs and you can invest in them. So ARK Invest is a company that has done that. So you can see that here, all the different ETFs. They have one for innovation companies, next generation internet companies, genomic revolution, autonomous tech. So if you look at the ARKQ, you can see all the different companies that comprise this ETF. So Tesla, Trimble, Kratos Defense and Security. So and you can see the weighting in the index in the ETF. So if you wanted to invest in, let's say, autonomous tech and robotics as a whole, so you like the general industry, but you're not sure entirely which stock to pick, you can invest in an ETF, and that'll track the general growth of it. So how can I, as an individual, get involved in the stock market and investing? So there are 2 types of investing. There's retail investing, which is individuals who invest their own money, typically on their own behalf. So like me and you, let's say we open a Robinhood account or a Fidelity account for individual investing. We can certainly do that. Or institutional investing, which is a company or an organization with employees who invest on behalf of others. So let's say investment banks, hedge funds, people that work in the investment banking department of a big hedge fund like Goldman Sachs, for example, they are going to invest for the institution. And because of this, institutions usually have a lot more knowledge, access to resources, data that maybe not be available to the average Joe, like me and you, if we were trading. So in recent years, you might have heard of a trading app called Robinhood. So Robinhood is a free mobile app that was initially announced in 2013. And its goal is that it allows people to easily and effectively trade in the US stock market. And it's become one of the most widely used resources for retail investing in modern times, because it allows you to trade without commission. So usually you have to go to like a stockbroker, and you have the stockbroker to trade for you. So let's say you tell the stockbroker what you want to buy. He considers your options. He buys the shares for you, and then you get charged a commission fee. So you have to make an initial payment to even start investing or to sell, or basically if you do any action, you have to pay a commission fee. However, Robinhood gets rid of that commission fee. So it makes it much more easier to trade for yourself without having to charge a commission fee. You just have to worry about how much money you want to invest in that stock. So it gained major popularity in 2015, and today it has over 23 million verified users on their platform. Robinhood has brought trading into the scope of the younger generation. So the average user of Robinhood is in their early to mid 20s. and it continues to appeal to a younger demographic. So a lot of apps like Robinhood have been released giving anybody access to a way of personalized trading rather than having to consult a stockbroker. And because of this, retail investing, or as we discussed, individual investing, has increased greatly in the past 5 to 10 years. Anyone that has a valid social security number and is the age of 18 or older can register for a Robinhood account and begin their own investing. So in the figure above, you can see a large increase in the amount of people investing. So during COVID, even when the market may have been crashing, which is the sharp drop between March and April of 2020 of the blue graph, which represents the S&P 500, which, remember, we talked about how that represents general economy health. There's been an influx of young traders hoping to make huge profits off of the post-pandemic rebound. So if you wanted to do let's say you didn't want to invest your real money yet on a site like Robinhood, on a site like Fidelity, there are a lot of different resources where you can do practice trading. So this is an app that I personally use. It's called Tiger Trade, and you can use this to trade in the real market by putting money into it. Or they have an option on this app where you can start a $100,000 paper account. So you don't have any real money. You're not going to lose anything if your investments go down, but it tracks the real market in real time. So it's essentially as if it gave you $100,000. You can invest it. You can practice your investing strategies, your skills, and it's just a great tool because practice always makes perfect. And it's sort of easy to think of things conceptually, but when you put sort of money to it, it makes it more fun. It makes it more engaging, and it makes it sort of more aware of what you're doing. So those are resources I left with. So thank you for attending my seminar today. If you have any questions, you can definitely feel free to email me. My email is lawrenceng2020@gmail.com. So hopefully this slideshow was comprehensive. It was understanding. It gave you sort of a general overview. So in next week's class, we are going to get into, well, maybe not next week, but maybe in next class, we're going to get into technical analysis and the difference between technical and fundamental analysis and how you can start implementing these strategies to know what to invest in, know when to invest in, and how to turn your own profit.